Hey everybody, this is Patrick Zielbauer from Infinity. Let's go ahead and get started. Just want to make sure everybody can hear me okay. You can give me a quick yes in the box. That'd be great. Okay, fantastic. All right, let's do some risk stuff first, okay? Right here, trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations may change at any time. Past performance is not indicative of future results. So folks, only fund a futures account with risk capital. All right, that means money you can afford to lose without lengthening your retirement horizon or affecting your ability to maintain your lifestyle. Okay. If you have any questions about where you fall on the risk capital curve, so to speak, about whether or not this is something that's appropriate for you, please feel free to have a discussion with your representative in our office here. Everybody's got one, whether you're a client or just someone who's checking us out. You can reply to any email you get from Infinity, which will get you to the right person. If you're not sure, just send an email to trade@infinityfutures.com, and that'll get you to our management who can direct you. The other thing is I want to mention chartingclub.com is getting better and better. Okay, we are continuing to update this. There's a lot of good content in here. If you are interested in futures in general or in Sierra and our support for it, then register here. It's free. It's nothing to do with your live account in terms of your credentials or anything like that. There's no personal data besides your first name, last name, and email address. And you can sign up to get updates whenever we do videos about Sierra Chart in your email. All right, so a pretty cool database that we're building there. All right, now, okay, sorry about that. Okay, so what I wanted to do today is talk about some charting techniques and some tips just for more volatile markets. We talked about this briefly the other day. I want to revisit a couple of the concepts, and then I want to introduce another sort of charting technique that I think is both useful and also highlights some of the usefulness inherent to Sierra, which we offer and support here for those of you who don't know. And then we'll do an example of that. And I did a little paper trade today. It's just a simulated trade, but it was very much in line with how I've been communicating with my customer base over the last few weeks, given the volatility scenario. It's very consistent, and I wanted to go through that as well. All right. So the first thing I want to do is go through a couple of these comparison charts just regarding some of the other markets that you might want to be taking a look at here, considering the volatility picture. So one of the things that was in the description of this event is the idea that we are in an interestingly volatile market. The volatility comes and goes very quickly. October, November were very, very busy, both in terms of trading and volatility. Is very reminiscent of the brief stint of volatility we had in February of this year. And stepping back from the market for a minute, because of volatility is a wise thing to do. It doesn't mean you can't participate. What it does mean is that if things that are not working when the Dow is up or down 600 points are they used to work when we had 100 or 200 point range and now they're getting steamrolled, you really need to evaluate why that might be. Okay, what I have found is that in super volatile environments, traditional indicators tend to get just steamrolled right through. All the levels get blown right through, all the indicators get blown right through, and it requires a degree of adjustment. Some of the analysis might need to be adjusted. The number of times you trade may need to adjust inside of a day. One thing that I think most people don't do because they're so locked into a particular contract is they don't look at other markets. And I'd like to highlight just a couple of examples of other products that we offer at Infinity that many people here probably already have access to in their account. And if they don't, we could easily add them. And let's go through some of the mini and micro contracts that I think are particularly interesting. So the first one here is the euro. So on the left side, you've got the full-size euro, okay, 5-minute time frame, and on the right side, you've got the micro. What this blue line is a line that I manually drew using this study we have called the chart calculator. Chart calculator is this thing where you draw from A to B, and that gives you some data about point A to point B. In my example here, the way I have the settings set up, it only shows me the percentage change and the dollar amount, or the currency value is what they say, CV. But you can have it do other things like number of bars and number of trades and volume and all kinds of other data can be added there. I just like to keep it simple with these two things. So this is a $737 move in the full-size euro. And this same move over the same time period in the micro is $72. All right, now the micro euro is a bit of an extreme example, kind of like the micro gold, which we'll touch on in a minute because it is so small. Okay, the margin on it, even overnight, is like $200. It's a very, very small contract. It's very difficult to make or lose a great deal of money when you're trading a 1/10 size product. Okay, that is the truth. However, if you are trapped in the simulator, so to speak, where you are struggling with the mental, switching of paper trading to live money, or if you want to trade, if you do want to participate in these products because you like it or you enjoy it and you think there's something there, but you just can't afford to take these super wide stops with your regular contracts, maybe look at this. These markets are moving right now with Brexit and all the tariff talk and all that stuff. There are a lot of opportunities in the currencies, and the micro euro on the right here does trade enough to be for you to trade during the day. And it trades maybe, let's see what it did today, maybe 10,000 contracts today. Usually on a busier day it might do 20,000 or so. So it's not a super volatile, or excuse me, a super liquid market, but it's definitely tradable. And if you get a few ticks of slippage on your market orders or your stop orders or whatever from time to time, so what? It's $1.25 a tick. If you're trading this contract, you're not going to be doing it for for 3 ticks at a time, like you were, in the old FX platform you might have used 10 years ago. All right, so this is the kind of contract that it's super small, it's tradable, you can scale. Okay, if you have a reason to be long or short and you're willing to buy a range of prices rather than a set price, you can scale into it without accumulating a massive position. So to me, it's a good way for people who are interested in participating in a volatile market to be able to do so with their logistical part of their brain intact, and that is don't over leverage the account. All right, so this is one way to do it. Again, if you're trading one micro, it's not very exciting, but you may find that it's a good way to bridge the gap out of the demo into the live environment. So that's one thing I wanted to mention. Let's jump over to the micro gold because it's very similar. Okay, this is a $510 move in the full size gold on the left. Okay, and this is a $48 move in the micro gold on the right. Okay, so they're not exactly the same because the micro and the full size, sometimes they get a little disjointed just by $1 or $0.50 or something here and there. You might see that happen from time to time. The micro gold's a little bit thinner. Again, not a great short-term day trading instrument, but if you have a trade you want to put on where you wouldn't be long or short the metals, the micro gold is a good way to do it. Again, super small contract. It's $1 a tick. So if you want to accumulate, say, a 50-ounce gold position, which is the full size is 100 ounces, you could scale into 5 lots of the micro gold and peel those off if the market reverses, or a day or two later if you want to get out of the position. The margins are so low that most people can afford to hold them. The micro gold margin, I think, is like $500 a contract. So if you're in a 50-ounce contract, you have a margin requirement of maybe around $2,500, give or take. I'm off by a few $100 per is possible, but it's a pretty small contract. And again, it's a pretty good way to participate. The rates on the small contracts, Robert, are significantly lower. You could talk to your rep about that, but they can tell you exactly what they're at. But they're smaller contracts. I wouldn't sit there and short-term scalp these contracts because it is true that they are less liquid. But again, for a longer term day trade or a swing trade that's going to be a few days long, it's very efficient. There is a micro silver, Chris, although we do not offer it because of liquidity issues. So we typically will not add contracts just because they exist, because a lot of them are so thin that they're untradeable, or that allowing you to trade them could put you potentially at risk because of a market that has no bid or offer. Get a little scary. All right, and then another one, probably the most noteworthy recently, has been the crude. Crude oil obviously just nuts in the last few days. This here is a $1,200 move or $1,240 move in the full size crude this morning from about 8 o'clock to 9:15 or so before things started to back off. All right, this move here, same start and end time. It's about it's a $625 move. So about almost exactly half, which is what you'd expect. So the mini crude is 1/2 the size of the full size crude. It's also not a phenomenal short-term scalping instrument because it is relatively thin compared to the full-size crude, which right now full-size crude is trading like 600,000, 800,000 million contracts a day. I mean, it's really incredible liquidity and volume traded. The half size trades way less. But again, if it's a shorter-term day trade, or excuse me, a longer-term day trade, or a trade that's going to last a few days, like let's say on Friday, you're like, you know what, this crude oil is overextended. couple of people I'm listening to are thinking, all right, this is enough's enough. It's time to get long one. Most people can afford to buy one half-size crude and maybe put a dollar stop, which is a $500 stop. I mean, even if you risked two full dollars, like let's say you bought crude around $50, you could risk it all the way down to $48 and only lose $1,000 on the trade. That's not bad, especially considering the likelihood of it continuing further into the 40s. It seemed like might have been relatively low. It would have been a relatively, in my opinion, reasonable risk reward sort of trade where you could afford to put one on and risk $500 per $1 move in crude. Whereas if you're trading the full size, that's a $2,000 loss. That's a little much, for most people who are used to day trading and have relatively restricted, daily risk profiles. Okay. Yeah, we are going to record it, and it'll be up on the Charting Club site in YouTube probably within a day or so. All right. Sean, we do offer the 6B, the currencies. There's there's a 6A Australian, 6B is the British. There are also micros of those. Okay, I don't have them up here just because most people are most interested in the euro, but we do offer the full-size currencies, including the Australian, the pound, the Canadian, Swiss franc, the yen, New Zealand dollar, even the peso. I think we do some from time to time, although that's pretty thin. We do offer micros in the euro, pound, and Australian. So if you have those contracts and you want to get the micros added, we can get them added for you. Nice part too is that the currencies are on the same subgroup as the S&P and the NASDAQ. So adding the microcurrencies does not make you pay an extra fee, assuming you already have at least either the S&P, NASDAQ, Russell, or one of the other currencies. So if you want that added, just contact your rep in our office and we'll get them added for you. Okay? And then what I'm also wanted to show here was a comparison of the indexes today. Okay, kind of from like low to high. So on the left side here, you've got the S&P. Okay, from here to here, that's an $1,187 move on a one lot. All right, the NASDAQ, to no surprise, is the outlier to the positive. That's a $1,980 swing from low to high, same exact time period. Okay, here's the Dow, which was a little bit more muted today. All right, $950, and the Russell, which was $620. All right, so the markets have fallen off after after the close. I don't know if there was some earnings or something's causing the markets to break down a little bit here, but I really want to stress that the Russell is an unsung hero, so to speak, in this kind of an environment. All right, if you trade the NASDAQ and you're getting your head ripped off every day, you may want to look at trading a contract like the Russell. Okay, the reason I like the Russell is because it is worth a lot less money than the other contracts, and so you can use a nice wide stop, like percentage-wise or in points, without necessarily risking a lot more money. All right, so as an example, and we're going to go through a hypothetical trade here from earlier today in a minute, but the Russell's a $50 point. All right, and when you look over a fixed period of time, and you say, okay, the Russell went from here to here over this time period, let's say a 3-hour period. If you go look at the S&P, NASDAQ, or the Dow over that same 3-hour period, you will usually see a significantly higher dollar amount move. Not all the time. Okay, that won't always be true. There will definitely be days where the Russell is the outlier. Okay, an example, and I could be off base here, but I remember this, something similar to this. When the tariff stuff started coming out at the beginning, there were days where we'd see like the Dow is down because of all the big industrial exposure to China, and the Russell's like making a new high at the same time the Dow's making a new low. Remember we saw that disjointed activity in the indexes for a while? We still are seeing some of it. Now we're seeing it with the NASDAQ because of the tech wreck, as they say, and all this stuff. There is always going to be, we just have to get used to the idea that these things aren't going to move in tandem for a while. And so, yeah, there will be some times where it's like, you're going to be trading the Russell because I mentioned it here, and then you're going to get tagged out as something, and it's like, oh, damn it, Patrick told me to do this. There will definitely be situations where something is the outlier, and it's going to be in your favor sometimes, and it'll be against you some other times. But generally speaking, in a market that is this volatile, trading a smaller contract with a wider stop and reducing the frequency with which you are trading throughout the day is probably your best chance of not getting crushed. So it doesn't mean you can't participate. It just means that you might not want to put on, 30 trades a day. Okay, if you're used to risking, say, $500 to $1,000 in a day, maybe do it on 2 or 3 trades instead of 25 trades. All right, you're going to pay less in fees, probably will be a little less stressful, more than likely you are not going to be the bottom or top of these little whippy moves where you find yourself mentally debilitated because the market tagged you out and then 3 seconds later it ran the other way without you. That's a little bit less likely to happen when you use these wider stops, right? So generally speaking, one way to allow yourself to continue to participate is to look for products that can meet your risk profile under stressful periods. And that's kind of why I like to bring up the Russell. I know that sometimes it's going to precursor, another move, as you say, Arthur, here. Sometimes it's going to follow. Sometimes it'll only be up 1% when the Dow is up 1.9% or the Nasdaq's up 2.1% and the Russell is the laggard. Okay, there will be other times where the opposite is true, but it's a great market. I mean, remember, most of the companies are based in the U.S. They're smaller caps, so you do get some volatility, but the contract is just worth a little bit less money, and that offsets some of the volatility that is built into the idea that it's a small cap index. Now, a few years ago, when the Russell was $100 a point, we wouldn't be having this conversation because the Russell was not only a small cap index, which was very volatile by its own nature, but it was also twice the size it is now. So it's huge risk. Okay, it was great in some ways, it was awful in others. Okay, we all got kind of annoyed when the Russell cut the contract from $100 a point to $50 a point, but now looking back, right, with the benefit of hindsight, I actually believe that it made the product much, much more accessible, and it made it a great alternative to ultra risky environments that we're seeing in some of the other indexes. All right. So anyway, that's something I wanted to mention, specifically about the Russell. If you don't have the symbol, right now the current symbol is RTYZ8. If you don't have it in your account, email your rep. Again, as long as you have the S&P, the NASDAQ, or any of the currencies, it will not cost anything to add the Russell to your account. It's the same margin requirements as the indexes. It's a market I think people should be looking at. All right. Okay, now let's go back to this. I want to go through this hypothetical trade idea here because there is something that I think that is happening right now with my customer base, and I think it's actually pretty interesting to see it happen. And I know that in some places people are being told this by people in the education space, and other times it's coming from themselves. But let's talk about it. So one thing I'm seeing a lot of right now is people foregoing the use of traditional indicators that are just based on moving averages and MACDs and stuff like that. And they're also a lot of people are foregoing these predefined levels like initial balance or a low volume node or something like that you would see in a volume profile, sort of like these levels that you used to rely on. A lot of them, what happens when the Dow is going to be down 600 points or up 600 points, they're just getting ripped right through, right? And so what I think is interesting is people are now looking at levels that are relatively arbitrary in nature, that are just based on certain multiples of levels that they do typically track on a day-to-day basis. So an example of this, what you see on the left-hand side and the right-hand side, see the blue dotted line in the middle of each of these? Okay, this is the volume weighted average price, VWAP. Okay, it's over here on the right-hand side as well, VWAP. All right, now the volume weighted average price to me is particularly interesting when the market is up or down in one direction for the majority of the day, and you start to see this kind of like pullback behavior where it really does feel like the pullback doesn't have strength. So this is a good example on the left-hand side here of the market kind of hovering throughout the day around the VWAP. And what I see people doing is instead of just looking at the VWAP or looking at like a moving average, they're actually giving themselves a lot of room by creating some multiplier that will result in a band of sorts being put around the VWAP. This one on the left here, this one was coined as the maximum permissible deviation. And the person I picked that up was from Raggy Horner at Simpler Trading. And it was basically the idea here that you've got this VWAP and then you've got this lower band and then this upper band. And as you look for opportunities, you're doing it in the context of how close we are to the band. And so an extreme move would be the market moving all the way down to this VWAP, lower band, or up all the way up to this band, which you will not see happen very often. And the way that this is calculated, and this leads me also into sort of a functionality thing that we'll talk about, is what it's doing is it's taking the high of the day versus minus the low of the day. In other words, the range of the day, dividing it by 2, and then you add it to the VWAP, and that yields this value. And then you subtract it from the VWAP, and that yields this value. So what's basically happening is you're having this kind of this range that you are creating, which is really just a multiple of the day's range divided by 2 added to that VWAP. And you're kind of creating this indicator kind of out of nothing. It's really what it is. But what it does represent is a reasonable measure of like an extreme move. It does make sense. It's based on the range. Okay, it's based on the volume weighted average price, which is the price that where the majority of the volume is trading. And to me, it's a good example of how you can take a step back from just regular this line crosses this line type indicators, and instead look at things in the context of extreme ranges. So on the right-hand side here, we just have a regular VWAP with some kind of regular standard deviation, I think. So volume weighted average price, I didn't really change anything here. So VWAP variance, I don't even know what the formula is for that, but basically it's calculating the first band is like a 0.5 variance. So what I did was I actually hid those. Okay, we got rid of those bottom and top bands. On the right-hand side, you can see they exist. Okay, they're here. But on the left-hand side, they're gone because I replaced them with this other band. And it's going to lead me into a functionality thing I want to show you here. But just to talk you through the idea of this hypothetical trade was, so first off, this market starts coming down. And this is a day where at the time, the market is already up significantly. All right. And this move looked pretty bad. But again, we're looking at the Russell. And so from a dollar amount perspective, it's not that much. So what had happened was, as the market is starting to break, this to me looks like the kind of scenario where the market's going to pull back. It's going to trick everybody into thinking it's in the middle of some massive, violent, day-long reversal where we're going to end up closing, the S&P is going to end up closing 35 points lower. And we started to get about, we didn't quite make it at this time, but this market started to get about 50% towards this maximum permissible deviation. So that's when I was thinking, okay, let's put one on here. And again, this is a paper trade, so it's just a paper trade. But let's put one on here, and then let's risk it all the way down to below the band. So this is an 8-point move in the Russell. All right, this is an 8-point move. That is a pretty big move in the Russell. That is $400. All right, in going back to what I was saying before, lots of you in the room and other customers of mine are more than willing to risk $400 or a multiple of that throughout the day. But for some reason, no one wants to do it on only 1 or 2 trades. Most people would rather trade in a hyperactive fashion where they end up, risking $400, but then they do 48 round turns on top of that, which is fine. We'll take it, but it's not going to last, and we know that. So, in my opinion, in this kind of environment, it's better to look at markets and techniques that allow you to risk relatively large amounts, knowing that you are not going to be trading as much that day. So this arrow I drew here just because I wanted to show the space between where the entry was and where the stop would have been. So this stop would have been down here at 1491.40. That's 8 points. Okay, it's exactly 8 points. That's $50 a point, $400 risk. All right, so the market gyrates around a little bit, and then it ends up coming back down a little bit. I didn't touch anything, and then it starts to rally. And then going into the close, things start to peter out a little bit. I tighten the stop up. It ends up getting stopped out. It's a $350 move in the Russell. Now, if this were the NASDAQ or if it were the Dow, it probably would have been a much bigger number. But who knows if I would have been able to afford the stop. I don't know if I would have been able to afford the stop if I were trying to put myself in the shoes of most of my customers, right? So an 8-handle move, Arthur, is a relatively large amount by any, I would say in any context in the Russell, but it's certainly way more than my typical customer will risk on a trade. All right, but you know what? I don't understand why that is, because this whole thing, this concept gets proven, over and over again, that if you in a super volatile environment, if you take really tight stops, you're going to trade a lot and you're going to chew yourself up. So this is to me a good example of a solid hypothetical trade idea that is based on the market reaching this kind of like almost midway point and me thinking, you know what, this is probably if I'm wrong, it's going to just keep diving, and so what? It's a $400 risk. But if I'm right and this is just a pullback, I might have a chance at something that runs the whole rest of the day. And it didn't quite happen that way, but there was a chance that this market could have made a significant new high into the end of the day, and that would have been awesome. But even without that kind of follow through, it still turned out to be a decent idea. Arthur says it makes sense. I get it. It's just unnerving while it's going again. Yeah, that's definitely right. I mean, why not just get out and then get back in on the same level for a second try? I don't think there would have been anything wrong with that either. Right? Why not just get out? I mean, why not just get out at the top? Who knows? I mean, it just depends on where your head was at and what was happening at that time. But my hope was to catch something that would have it was going to run all day. And that was what I was hoping for. The pink dotted line, Chris, represent where the entry was and where my stop would have been. Okay, so this is the entry price right here. You can also see the little blue arrow that represents the fill. This little black dotted line connects the entry to the exit. Okay, and then you can see the result of the trade right here. So the pink line, it was like, okay, let's risk this to a little bit below that maximum permissible deviation. So just imagine, like, this market would have had to just crush everybody all the way to get there. So that to me was an acceptable risk. Okay, if that happens, yeah, it was just wrong. Big deal. I mean, it's a $400 loss, but it's probably the only trade this person would be taking that day, maybe one more. But that's not an account killer. What's an account killer is when someone is risking that amount on a daily basis and they're doing it with 35 trades or 35 round trips. That's difficult, not only just financially, but it's difficult and, in my opinion, debilitating mentally. So again, to put things in context, you had a strong up day. Okay, you have the market pulling back through the VWAP. You have a historical precedence of the market pulling back, and one of two things is going to happen. Either it's going to rip everybody's heads off and reverse itself, and we're going to close 500 points lower, okay, or it's just going to hang out here for a while and then resume its trend, which is what I was hoping for, hence the long trade. And the reason it was done in the Russell is because of the ability for the Russell to sustain a significant stop in points and not necessarily risk that much money. All right, so does everybody kind of get where the idea is there? Okay, and also it's the concept too is that these levels, really are a function of volatility because they're based on the range of the day. So if the range is very, very big, these levels are going to be big. If the range is very, very tight, these levels are going to be tighter. So having some kind of guide that has got some precedence in reality, like what's happening right now, instead of like a moving average over the last 20 days, where who knows what that is even worth anything right now. That's why I feel this is relevant. Okay, Jim, the dotted lines were just the entry of the trade and the hypothetical stop loss. So this is the entry, and then this is where I was going to put a stop. Again, it's a hypothetical situation, but yes. Okay. All right. So now that we've sort of explained the concept, there's two other things that I want to touch on briefly, and then we're gonna try to do a couple of examples, and then we'll wrap it up. One other thing is, and I'm just gonna show this here. I'm not gonna do anything with it, but standard deviation bands are just a regular study that you can add in Sierra. Okay, if you're looking for an indicator that is going to show you something kind of like a Bollinger Band, but it actually just uses the standard deviation calculator that exists in Sierra. You can use it. Feel free to do it. I'm not going to talk about it, but it does exist. The other thing that I've seen some people do and ask me about lately is, all right, so why don't we use an indicator from a bigger time frame and put it on the smaller time frame and use that? And that's not necessarily a bad way to do it either, because you're using something that is taking into account more data and might discourage you from overtrading as well. This is an example of a Bollinger Band on a 60-minute time frame being projected onto the 5-minute time frame. So if you look at the chart on the right-hand side, you got a 5-minute Russell chart, but the Bollinger Band you're seeing up here is actually from the 60-minute chart here. It's being projected onto it using study price overlay. All right, so we'll touch on that in a second on how to do that. I'll do a very brief example, but I do want to go back to this MPD example here so that I can show you how to build something like this, because it's kind of interesting. All right, so Robert, and I failed to mention this earlier. Anybody who's interested, if you want a copy of these files, just email your representative in our office, and we will send them to you, so you can use them and work backwards off them, and so on. All right. So we'll show them. We'll send them. We'll actually send you the files. All you need is either a demo or a live account with us. All right. Okay. So let's check this out. So what I'm going to do is try to take you sort of from this on the right to what we see on the left here, and I'm gonna get this as close as I can, without making too many mistakes. But this actually highlights some of the cool stuff you can do in Sierra. All right. Before I do that, I'm gonna unhide some of the studies that are on the left-hand side. So if you right-click studies, you're gonna see that some of these are hidden. All right. The daily open, high, low, close study is hidden. I'm gonna unhide it. This high, low, and high, low divided by 2, these are hidden. I'm gonna unhide them. Okay. And then the upper band and the lower band, that's what these bands are here. Those are visible. So I'm just going to apply this, and you're going to see that the chart is going to change its behavior a little bit. The first thing that's happening is the high and low are now being displayed. So you're seeing now we're in the next session. So we're about to be in the next session. So it's showing a high here and a low here. But normally for the day, it would have been this high up here and then this low down here. Okay, so this high up here and this low down here. And then you see these like funny lines here at the bottom. Sierra has a bunch of arithmetic studies where you can take like a line and add something else to it and then graph that. Okay, so that's basically what's happening here. So what I'm going to do is show you on the right-hand side how we can get to something that you see on the left-hand side. On the right-hand side, what I'm going to first do is right-click and go to Studies, and I'm going to remove the top band and the bottom band. Okay, so I'm just going to change the draw style to hidden like this. Hidden, apply, and you can see now we just have the VWAP. Okay, so now we just have the VWAP. We don't have the bands around it. All right, the next thing I'm going to do is I need to add this daily open, high, low, close study. Okay, the daily open, high, low, close study is generating the high and the low that I'm using to calculate these ranges. So what I'm going to do here is go to Studies, and we're going to add the daily open, high, low, close study like this. And we're actually going to hide the open and the close because we don't care about those. All I care about in this context is the high and the low. If you want to see the values of the high and the low, you can put the value label on. And we want to make sure that the reference days back is 0 instead of 1. Okay, we want it set to 0 because we want to be referring to today, not yesterday. All right? I don't think I checked that value label, did I? Oh yeah, I did. It's just showing down here because now it thinks we're in the next session. So, okay, so that high, let's just make that the same color as the one on the other screen, or as close to color as we can. And then the low, we'll make it that dark maroon color, so it'll look similar as well. All right. So now we've got the high and the low. So we've got the VWAP, and then we've got the high here, and then we've got the low down here. All right, and that's around 1486, and this is around 1486. So now we're in pretty good shape. Now, the next thing that we need to do is I need to calculate the range. So I call that high-low, but really what that study is called is the study subgraphs difference. So what you'll notice in Sierra is if you right-click and go to Studies, if you go down to like the S's, you're going to see all these like arithmetic studies like this. Okay, study subgraphs, multiply, reverse order, standard deviation, blah, blah, blah. The one that I'm looking at in this case is the study subgraphs subtract / difference. Okay, and what that is going to do is it's going to let us pick one subgraph and then subtract it from another subgraph. That's going to yield the number. All right, so what I'm going to do is add that, and then in the settings section, it lets us pick what are the inputs. All right, well, the first thing I'm going to do is go to the daily open, high, low, close study and choose the high. All right, and then the second one, I'm going to go to the daily open, high, low, close study, and I'm going to choose the low, like that. All right, we'll put it in region 2, push apply, and you can see right away we're getting this visual response. So I'm going to clean up the colors a little bit. Let's go to subgraphs. Let's make this difference line, this blue color, just so we can see a little bit better. And again, I know I'm ripping through this, but it will be posted, online and everything. So this line is a visual representation of the range. So the range is up here, it's up here, it's up here, it's up here all throughout the day. When the session reset here for us, the number goes way down because now it's only looking at this value. But what you should be able to see here very clearly is that this value is representative of the range of the day. All right, there's no doubt about that. Now, what we would then do is right-click and go to Studies, and we're actually going to choose another one of these things, and that is going to be called the Study Subgraph Divide. So I'm going to add it. You'll see that if we were to go back to our original study, that should be the next one, Study Subgraph Divide. Yep. So I'm going to add the Study Subgraph Divide, and what are we dividing by what? Okay, well, it's going to be based on the difference that we calculated. Okay, so it's based on the difference, which is this value, and we want to divide it by 2, because in this case, I'm trying to find the range of the day divided by 2. And when I push apply, now we get a new value. All right, and we can, again, make the color scheme a little bit different so we can see it a little bit better. And see this? Okay, so this line here being right around 2 and here right around 12 is exactly half of this line. So we've now divided this value by 2, and it yields this value. The reason why I put them over here on the left in the same region is just if I did ever want to have this displayed, these numbers were close enough together where I could put them kind of next to each other without getting confused. So what I would do is go to Settings, and in the chart region, you can actually change the region from 3 to 2. So now they're up both in the same spot. All right, so now we've got the range of the high and the low. We've got the range here, and then we've got the range divided by 2. All right, now the final study that we added here was Study Subgraphs Add and Study Subgraphs Difference just Study Subgraphs Difference. So what we're doing here is now I want to take the VWAP and add this value, and then I want to take the VWAP and subtract this value to get those bands. And so here's how that's going to look. All right, we're going to go to the arithmetic studies again, and we're looking for Study Subgraphs Add. Let's add it. And in the settings section, it's going to say, all right, what are we adding to what? So the first thing I'm going to do is choose the VWAP. There's the VWAP. The second input is going to be the Study Subgraph Divide, which was the divided by 2 range that we did. And I'll just put this in region 1. And let's format it just so we can very clearly see it. I'm going to put it in this purple. We're going to make it really thick and visible. All right, there it is. All right, so that represents the upper band that we saw over here. It's the same thing. I just wanted to make it a little clearer. Then what we can do is we can go back to the studies available and look for Study Subgraphs Subtract / Different, or Study Subgraph Subtract / Difference. Okay, add it. And then in here, it's like, okay, well, what are we subtracting from what? Well, the first input is going to be the VWAP, and the second input is going to be, we got to base it on the, oh, my mistake here. There's our divide, the result. So the first input is the VWAP, and the second input is that divided by 2 number, which is right down here. We're going to put this in region 1. I'll just make this a different color so we can see it. Let's do like this orange. Like this. So at that point, these 2 things are basically identical. They actually are identical. See this number down here, 1497.27. Okay, it matches. And you can actually just go back and hide the studies you don't want. So maybe I hide the daily open, high, low, close. Maybe I hide the difference. I hide the Study Subgraph Divide. I hide the Study Subgraph Add. And we just need to keep, or actually we need to keep the add and the divide here, or the add and the difference, because that's these 2 bands, and push apply. And now we're kind of back to where we started. So the objective of this is to show you that you can create a lot of your own stuff in Sierra using these arithmetic studies. It's one of the really the most powerful features of the program, because it's very open-ended. You just have to be able to think through what it is you're actually trying to do. And to me, the reason why this is so uniquely interesting is because it forgoes a lot of, looking back several days. With the VWAP, you're not usually looking back to the beginning of the session. You're not looking back like weeks, because every day is like its own animal here. We have days where we have nothing happening, and then we have a ton happening. And if you have a day where the market has already made a dramatic move in the morning or overnight by the time you're willing to take a trade opportunity, it does, to me, make sense that the indicators and the risk you're putting on is going to be some sort of a function of the range of the day. Now, if we go back to where the Dow is up or down 115 points every day and the S&P's range every day goes back to, 25 points or something like that, or 20 points, then maybe you do away with this again and you go back to the traditional stuff. But I think in a time where we're seeing these dramatic moves, often, very early on in the session, I think it does make sense to build out a setup that is rooted in the day's range. And this to me is a pretty cool way of doing it. All right, now again, we can send the files out to everybody. It's very easy to import them, and then you can use these on your own. I know that flying through the arithmetic stuff is it's just very fast. I'd have to do an entire presentation just on these, which we certainly could do. But you really just have to think through what it is you're looking to achieve, and if you can spell it out, then there's a good chance that you can create something, or we can help you create something that is going to demonstrate or realize that vision in Sierra without really any real programming. There's no programming here. It's just dividing and adding and knowing what studies to add. So pretty interesting stuff. I hope you get something out of that. The other thing that we just talked about briefly was this Bollinger Band overlay thing. So as an example, if I were let me just duplicate this 5-minute chart here real quick. I just want to show you how to do this. I'm gonna erase the chart or the study for a minute. So if you want to take an indicator from one chart and overlay it onto another, you're going to be looking for a study here called study price overlay. Okay, so you're going to add that onto your destination chart. In this case, it's the 5-minute. All right, so just to recap, we already did this on a 5-minute. I just removed it on a copy of it so I could show you how to manually do it. All right, so I'm adding the study price overlay study. Now, unlike a moving average or volume or something, we have to give some instruction here. We can't just add this and expect the chart to know what we're looking to do. So in the settings section, the most important settings and input option you're looking for is the first one. It says study to overlay. When you click here, you get these two drop downs at the bottom. On the left-hand side is all the charts in your chart book. So you need to know which one you're looking at. You're looking at chart number 1. It's a 60-minute. You can see the number in the top left. Okay, chart number 1 right here. And then what do we want to overlay? Do we want to overlay the main price graph? Or do we want to overlay a study that exists on the chart? And this dropdown will be a long list of all the studies on the 60-minute chart that you've got. In this case, it's easy to pick because we only have one study, the Bollinger Band. But normally you're going to see all the studies that you have here on the 60-minute chart. So you just select it. All right, and then put it in the right region. Okay, region 1 if you want it on the main price graph. Region 2 if it's like a MACD or something that belongs down here, you could choose a different region number. But in this case, we want it in region 1, and then just push apply. All right, in most cases, you're not going to have to make any adjustments to this. There might be some situations where you have to choose some other things in here. For most people, you don't really have to change much. All right, Chris, we've done a lot of the moving average overlays as well. I'll show you one real quick here. So what Chris is suggesting is, can we see a moving average overlay? So let's say that I add, let's just say a 20-period simple moving average. Okay, so I'll go right now I'm on the left-hand chart. So it's 20 periods. Let's make it something noticeable. Okay, so this is a 20-period simple moving average, all right, on the 60-minute like that. Okay, see that? Now what you would do is you go on the destination chart, right? Click Studies, add the study called Study Price Overlay. Okay, and then click on the study to overlay and then pick what it is. All right, 60-minute, that's where we're overlaying from. Okay, notice now we have a moving average here that wasn't there before. I just pick it, put it in the right region. Oops, excuse me, wrong drop down there. Right region, region number 1, push apply, and there it is. So it's quite simple to do this. You can definitely do the same thing, Tom, with drawings. You don't do it from this interface because these are for studies, not for lines. But if you want to have a line automatically copied from one chart to another, you can easily do that. We've done presentations on it. There's a really good YouTube video on it as well. But just as an example, let's say that I want to put a line, right here near the top of this move at 1512-ish. So I put that onto my 60-minute. If you go onto the 5-minute, right click, go to chart settings. You're looking for this section under advanced settings 2, where it says copy chart drawings from chart numbers. This is chart number 1 that we're copying from, right? It's this number up here. So I just put a 1 in there and push apply, and you can see the line automatically copies over. So it's a really good way of taking lines that you've drawn on bigger time frames and then automatically projecting those onto shorter time frames. All right. Okay, cool. I think that's probably where we will leave it. I mean, hopefully everybody got something out of that. I mean, I think that this is a unique situation. Everybody should be, doing their best and making their best effort to keep their head screwed on nice and tight. But I think that it's especially important right now to consider the size of the contracts you're trading, consider the frequency with which you're trading, and consider adopting a strategy that incorporates, something related to volatility, so that you can be reasonable about your expectations of, about staying in these trades. All right, hopefully, hopefully that's useful. And again, if anybody wants copies of the files, just email your rep in our office. We'll get them to you worst case, tomorrow morning, and go from there. All right. So thank you again for coming to the presentation today. We appreciate it. Again, hopefully you found it was useful. And if you have any questions or comments, just talk to your rep in our office, and we'll get you squared away. All right. Okay, everybody. Thank you again. I'm going to read some risk stuff here one more time, and then we'll close the room up. We'll see you next time. All right. Thank you, folks. Appreciate it. All right. Trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All righty, everybody. Thank you. Talk soon.